I think the probability is that even if we do have a recession, for some reason the market's not going to make a new low, because I think once you take the inflation fear off, that helps a lot, because that's the big bogeyman. And the next one is rates. And as rates start coming down, that's the other big bogeyman. And that can really give things traction.
And that is the recipe of a bull market. If earnings continue to grow high single digit or mid single digits, at least in nominal terms, and the PE stays where it is, you get a high single digit bull market.
As a result of the better than expected July inflation reports and the subsequent rally in the stock markets, investors are getting more confident that this is not a short relief rally at the beginning of a bull market. As of press time, the S&P 500 is over 16% above its June 16 low and only 11% below its all-time high. Though there is still too much uncertainty to have a conviction, analysts and other market experts believe the chances are greater that a new bull market has started. While one could argue that the news on the economy and corporate profits has not been anything near spectacular, it has been good enough for the stock markets. This is probably because of how low the bear market pushed market sentiments, leaving major indexes alarmingly oversold. So any improvement, however large or small, was enough to make significant changes in the markets. Experts believe the rally will not be short-lived, but they caution that the next leg higher will depend on the market gaining more confidence that the inflation battle will soon be behind us. If that happens, they argue that we could get the promised soft landing, which will propel the Federal Reserve to slow down on tightening. In a recent interview, Real Vision CEO and co-founder Raoul Pal and Jurrien, the director of global macro at Fidelity Investments, discussed the possibility that we have come to the end of the bear market. They also discuss how this bear to bull market transition compares to previous ones. Please watch, like, and share this video as it provides a much-needed insight into the current state of the markets. Also, ensure you drop your comments and observations below and subscribe to the channel. Thanks, and enjoy the video.
One of the many businesses I run is a fund-to-fund business in crypto, investing in digital asset hedge funds. We can see by the performance most people are underweight. If you look at the equity market in technology stocks, the big players like Coatue, the biggest hedge funds in the world in technology, 75% cash. And then you see on crypto Twitter and FinTwit, people raging about the market going up. They're raging because everybody expects a leg to new lows. It's the story, and Jurrien will talk about it, about are earnings going to be taken down? And I've gone back through history. I think the probability is that even if we do have a recession, for some reason the market's not going to make a new low, because I think once you take the inflation fear off, that helps a lot, because that's the big bogeyman. And the next one is rates. And as rates start coming down, that's the other big bogeyman. And that can really give things traction. And it's a very complicated story in corporate earnings right now, because nominal versus real earnings make things really confusing. So I just have a sense that I did a Twitter poll and 25,000 people answered. And I said, how many of you think there's a new leg lower? 70%. I said, how many of you are underweight? 75%. I'm like, okay, there's no way we can go back to the lows. Well, we could go back to the lows. I find it difficult to think we could break it, even though I think the economy goes down the toilet.
If we avert a recession, which is a close call, because kind of technically, we've had the 2 quarters of negative GDP growth, but certainly by the traditional NBER defined standards of a recession, we are very likely not in a recession, at least not yet. So if earnings survive, either because the economy does not implode or because inflation creates the illusion of nominal positive earnings growth, then I think the market has put in a solid bottom. We were down 25% at the low. You look historically, going back 150 years, recession bear markets where earnings growth contracts tend to see a decline of 35% over 19 months, but non-recession bear markets like 1994 or 2018, 2011, other periods in history tend to go down only 22%. So we were down 25%, which means we priced in more than enough if it's a purely evaluation bear market, which is what we've had, right? The PEs are down over 30%, at least at the bottom. And that was completely rational and justified on the basis of rates rising, liquidity conditions tightening. We all know the story about inflation and the Fed. And at 25% of a drawdown, we priced in 70% of a recession scenario. So even if we do get a technical recession and we have an inventory cycle, but not, mass layoffs and things like that, then you could argue that for a mild recession or a technical recession, we've priced in more than enough of a decline.
Jurrien,
yeah, go ahead.
Can I ask you a question? The two, because I've been thinking about our discussion about this recently, and the two that stand out to me that were similar in kind of inflation and limited bear markets was 82 and 1990. Those were both massive inflation peaks, but the market only came down 27% in 1982 and 20% in 1990. Yeah. Have you thought about why those were different? Because they were both full recessions. ISM went down to 35.
Yeah, I think 1990 certainly bears some resemblance, and ironically, the bear market low at down 20%, as you mentioned, in October of 1990 happened after the NBER had declared the recession, starting, or it bottomed before that. So that certainly happens, on a regular basis. The early 80s, of course, was a massive inflation peak, but it also came after a 14-year secular bear market. So from that, and the PE was 7, right? So from that perspective, I think there are not that many similarities, but certainly the 1994 was, of course, a successful preemptive strike by the maestro, and he gave back some of those rate hikes in 1995. But for me, the bigger story is when we assume for a moment that the bottom is in, what's going to be a catalyst for the next bull market, right? Are we in a new bull market or not? And the problem is that, and actually, if we pull up slide 9, if you want to share that. So, the 2-year yield turned upside down has been a very good proxy for the PE ratio for the S&P 500, just like it was in 1994. And so what we're seeing is that, the market is pricing in peak Fed later this year at around 3.5, but the 2-year yield kind of is staying sticky at those levels because at least on the front end of the curve, it doesn't look like the 2-year is going to come down as much as, let's say, the back end of the curve. So with this rally, we're at 17.7 times forward earnings. There's a gap opening up there. So, bull markets can be led by valuation expansion or earnings expansion or the combination of both. And so I think if we are in a bull market, it's hard to make the valuation argument because the further we go, if it's not met by a lot of Fed easing, and of course we'd have to ask ourselves, if the Fed were to ease a lot, what would that mean for earnings? So if it's not led by valuation expansion, it just has to be earnings growth to carry today with stable valuations. And that is the recipe of a bull market. If earnings continue to grow high single digit or mid single digits, at least in nominal terms, and the PE stays where it is, you get a high single digit bull market, but it's not the kind of 20-30% increase that we tend to see off of the bottom. So for me, the bigger question is what's going to be the story if this is a bull market, to how to sustain it.
It's a turning point for crypto. That's what I think.
There are certain technical analysis indicators that have historically signaled major reversals in the market. An example is the 50% retracement level, a key chart level that has always signified the end of a bear market. On Friday, the S&P crossed that critical level of $4,321, a 50% retracement from the January record high of $4,796.56. Experts have pointed out that there has never been a bear market rally that exceeded the 50% retracement and then dropped to new cycle lows. In addition, the percentage of S&P 500 stocks trading above their 50-day moving averages has crossed the 90% level, which has historically signified the beginning of new bull markets. As of press time, it was 90.65%, increasing sentiments that prices could rally back to the old highs before dropping to new lows. What are your thoughts about the recent gains in the stock market, and how do you think it could impact the cryptocurrency market? Please drop your replies as well as your comments on Raoul Pal and Timur's assessment of the markets in the comment section below. Also, sure you like this video and subscribe for more like this. Thanks for watching.